In this video, we will explore the different trading costs that you will encounter when participating in the equity derivatives market. When you trade, your expenses are generally divided into three main categories, which are user charges, statutory charges, and impact costs. Understanding these is very important because they directly affect your final profit or loss. You can think of user charges as the fees you pay for the services provided by your broker and the stock exchange. First, we have brokerage, which is the commission your broker takes for placing your orders. Usually, this fee is lower if you are doing intraday trades, and the rate can vary depending on the extra services your broker gives you. In the same way you pay your broker, the brokers themselves must pay transaction charges to the stock exchanges where they are members. Now let us look at statutory charges, which are the official taxes and fees mandated by the government and regulatory bodies. These include the Securities Transaction Tax or STT, the Goods and Services Tax or GST, and stamp duty, which is a state level duty. On top of these, you also pay SEBI turnover fees, which are regulatory charges used to oversee the market. To give you more detail, the current STT rates for equity derivatives depend on the type of trade you are doing. If you sell an option, you pay 0.10% on the option premium. If you are the purchaser and you choose to exercise an option, you are charged 0.125% on the settlement price. For those selling a futures contract, the rate is 0.02% of the price where the trade happened. In addition to those taxes, we have specific transaction charges, which are fees for trading through the stock exchange. These costs vary depending on whether you are trading in equity, futures, or options. It is important to remember that these are charged on both the buy and sell sides of your trade. For options specifically, the exchange calculates this fee based on the premium value, and you should always check the latest exchange circulars for the current rates. Another small but important fee goes toward the Investor Protection Fund Trust or IPFT. The stock exchanges created this fund to protect you by covering investor claims if a trading member ever becomes a defaulter and does not have enough assets to pay. This fund is also used to help with investor education, awareness, and research to help you become a more informed trader. If we look at the current IPFT charges for the NSE, they are quite specific for each market segment. For NSE equity and NSE futures, the charge is 10 rupees per crore of the traded value plus 18% GST. For NSE equity options, the fee is 50 rupees per crore of the premium value plus 18% GST. We should also clarify the other statutory rates that the central government and SEBI collect. The GST is charged at 18% on the combined amount of your brokerage and transaction charges. Stamp duty is charged to buyers, where equity futures buyers pay 0.002%, which is 200 rupees per crore, and equity options buyers pay 0.003%, which is 300 rupees per crore. Finally, the SEBI turnover fee is 10 rupees per crore plus the applicable GST. Beyond these visible fees, we must talk about the bid-ask spread and impact cost, which are costs you do not pay directly to anyone. These happen because of market imperfections or a lack of liquidity. Because of this, if you place a market order to buy, you might end up paying a higher price than expected. Similarly, if you use a market order to sell, you might receive a lower price. The difference between the best buy price and the best sell price is what we call the bid-ask spread. We can see this in action by looking at a sample order book for an option. On the buy side, the best bid price is 16.60 for 19,950 units. On the sell side, the best ask price is 16.80 for 2,850 units. The gap between these two numbers is the spread that affects your entry and exit prices. To understand how this costs you money, imagine an investor who is in a big hurry to buy and then immediately decides to sell. They would pay the ask price of 16.80 but only receive the bid price of 16.60. This quick move results in a loss of 0.20 per lot. We use impact cost to measure this, and the larger the spread is, the higher your impact cost will be, which usually happens with stocks that do not have many traders. To put everything together, let us look at a real world example of a trade ticket. Suppose you take a short position by selling one lot of index futures at a price of 17,500. Since the lot size is 50 units, we calculate the contract value by taking 1 multiplied by 50 multiplied by 17,500. This gives us a total contract value of 8,75,000 rupees. Now, we can break down the total cost for this specific trade. For a contract value of 8,75,000 rupees, the brokerage at 0.03% is 262.50 rupees. The STT at 0.02% is 175 rupees. Exchange fees at 0.002% are 17.50 rupees. Both SEBI charges and IPFT charges at 10 rupees per crore come out to 0.88 rupees each. When we add the GST of 18% on those combined fees, it is 50.72 rupees, making your total trading cost 507.47 rupees. As we wrap up this video, there are two important notes to keep in mind regarding our example. First, the 0.03% brokerage we used is just for illustration because many modern brokers now charge a flat rate per order. Second, you might have noticed we did not include stamp duty in our calculation. This is because stamp duty is only charged when you are on the buy side, and in this example we were looking at a short or sell position.